Hello, America. I'm Kimil Chandler, and this is Qualitative Listening. Today's episode: QE hurts the poor and QT hurts the rich. As we wind down quantitative tightening and once again repeat history with the failed quantitative easing, I'm going to explain how QE hurts the poor and helps the poor. I'm also going to explain how quantitative tightening, or QT, hurts the rich and helps the rich. So grab your notebook and pen for this episode. Let's begin. Alright, what is QE? QE is when a central bank like the Fed buys assets, usually government bonds, to inject money into the economy. The goal is to lower interest rates, boost borrowing and investment, and increase spending in support of job growth. This is how QE might help the poor. Reduces unemployment. Lower rates can stimulate job creation, especially important for low income workers who are most vulnerable to layoffs. Keeps credit cheaper. Cheaper loans can help small business renters and homeowners access financing. It stabilizes the economy. In crisis periods like COVID, QE helped avoid deeper recession, which tend to hurt the poor the most. That was how QE might help the poor. Now, how QE might hurt the poor. Asset inflation. QE drives up the prices of stocks, real estate, and other assets, which mostly benefit the wealthy who already own them. It widens inequality. The rich often get richer fast during QE because of asset ownership, while low income households see only small gains. The cost of living. As asset prices rise, housing and rent often follow, making it harder for low income families to afford basic needs. So, what's the big picture? Although QE is designed to help the entire economy, but in practice, its benefits are distributed unevenly. Wealthier people benefit more directly and immediately. Poor people may gain through better job markets, but they don't typically see the wealth boost from rising stocks and home values. So while QE isn't intentionally harmful to the poor, it can contribute to greater inequality unless balanced by the targeted fiscal policies, like affordable housing, wage support, and tax reform. Next up, how quantitative tightening affects the rich. Quantitative tightening is when a central bank pulls money out of the economy by reducing its balance sheet, usually by letting bonds roll off or selling themselves. Can definitely sting the wealthy, especially those who have heavily invested in financial markets and debt leveraged assets. Let's go over each reason why. Number one, asset prices drop. Stocks, bonds, and real estate often rely on cheap money and investor confidence. When the Fed tightens, liquidity dries up, interest rates rise, and valuations fall. Since wealthy individuals typically hold majority of these assets, their portfolios can take a hit during quantitative tightening. Next, higher borrowing costs. Wealthy people often use leverage, borrowing to invest in businesses, real estate, or stocks. QT pushes interest rates up, making borrowing more expensive and reducing profit margins on leveraged plays. It also chills the M&A market and slows down speculative investment activity. Next, pay attention to this because I'm going to do another episode on this key topic. Business valuations drop. Many high net worth individuals own or invest in private companies. QT increases discount rates used in valuation models, leading to lower business valuations. Venture capital and private equity also suffer, making fundraising exits harder. Weaker liquidity and fewer big deals. Big ticket sales like luxury real estate, art, yachts, and companies slow down when buyers can't access easy credit. QT chills deal flow and slows down big exits, IPOs, and M&A, all key wealth builders for the ultra rich. Hedge fund pressure. Many hedge funds and investment vehicles used by the rich depend on liquidity and arbitrage. QT can create tighter spreads and lower returns and more volatility, hurting performance. Next, strong dollar hurts global investments. QT can strengthen the dollar, which makes foreign assets and earnings less valuable in dollar terms. A common portfolio hit for international investors. QT doesn't usually hurt the rich through income, it hurts them by shrinking their wealth, making leverage more dangerous, and weakening returns on businesses, and slowing down liquidity. To make a long story short, they don't go broke, but their financial playground gets a lot less fun. That's the show, folks. Thanks for listening to Qualitative Listening.